Welcome to The Explainer. Today, we're diving into something that's got a lot of people scratching their heads in the crypto market. On one hand, we're hearing about a short-term volatility nightmare, but on the other, predictions for an explosive boom by 2026. So how can both of these things be true at the same time? Let's get into it. Yeah, it's a real head-scratcher. You've got analysts warning about this volatility nightmare just around the corner. But then you look a little further out to 2026, and the forecast is just incredibly bullish. So what's the deal? Well, it looks like the answer is tied up in these massive economic forces that are pulling the market in totally different directions. Okay, so let's talk about these macro crosswinds. We're talking about politics, AI, and what feels like a tale of two completely separate economies. And this really gets to the heart of the political uncertainty. The idea that the Federal Reserve, the institution that literally controls interest rates, could lose its independence? That throws a massive wrench into the works for all markets, and especially for crypto. So this really forces us all to ask a huge question. Is the Fed going to stay independent? Or could political pressure just open the floodgates and pump a ton of liquidity into the market? The answer, whichever way it goes, has some absolutely enormous implications. And, to make things even more confusing, it really feels like we're living in two different economies right now. The source material we're looking at points out that this booming AI sector is making GDP numbers and the S&P 500 look great. But at the same time, the average person is really feeling the squeeze from the high cost of, well, everything: food, housing, electricity. And listen, this isn't just some vague feeling. We've got prominent analysts like Tom Lee pointing to specific political events coming up early next year, things like the Fed chair nomination, as major drivers of all this volatility that's supposedly on the horizon. Okay, but here's where it gets really interesting. What if all this chaos isn't random? The analysis we're digging into today introduces this fascinating theory that actually all this volatility is happening by design. They call it the composite man theory. And the basic idea is that these huge institutions, the big banks and funds, they act like one single coordinated player to intentionally manipulate the market. So from their point of view, volatility isn't a bug, it's a feature. It's their primary tool. And this right here, this is basically their four-step playbook. Step 1, create a big sell-off. Step 2, convince all the retail investors that the bull cycle is over, time to panic. Step 3, while everyone else is selling, they swoop in and accumulate everything at cheap prices. And then, step 4, they flick the market and send it rocketing to the upside. And this is the key takeaway, right? That exact moment of maximum fear, when the average investor is absolutely convinced things are about to get worse, that's often the precise moment these institutions see their biggest opportunity. It's a total mind game. All right, so keeping that theory in mind, let's look at the actual price levels for Bitcoin that analysts are watching as this whole potential shakeout plays out. First up, we've got $96,000. Now, the analysis calls this the max pain level for options. What does that mean? It's basically the price where the most people holding options contracts end up losing their money. So think of it as a huge wall of resistance on the way up. Okay, now let's look at support. $85,000 is being called out as a really critical short-term floor. You can think of it as the first major line in the sand that the bulls are going to want to defend like crazy. Now, what happens if that $85,000 level breaks? Well, the analysis suggests that all eyes are going to turn to $74,000 as the next major support zone to watch. And then, in a real worst-case shakeout, the kind of move designed to cause maximum panic, the analysis points to a potential bottom somewhere between $60,000 and $65,000. This is what some might see as the zone of max opportunity for those big players to accumulate. But, and this is a big but, in the middle of all this bearish talk, there's this really fascinating counterpoint. A key indicator on the weekly chart is apparently flashing what's been called a historically great buy signal, a pattern that in the past came right before major moves to the upside. So, okay, if we're assuming the long-term outlook is bullish, how does an investor even begin to prepare for that? It's really interesting to see the difference between what the crowd thinks is a safe bet versus what one particular analyst is picking for a more defensive portfolio. So a community poll asked people, what's the safest altcoin basket you could build? And you can see here almost half the voters, 46%, went with a combo of XRP, Chainlink, Litecoin, and Cardano. But when analyst Tim Warren was asked the same question, he had a slightly different take. His top 4 defensive plays for 2026? Ethereum, Solana, Chainlink, and XRP. A little more focused, a little different from the crowd. And his reasoning for including XRP is actually pretty interesting. He says that whenever he talks to traders from the traditional finance world, TradFi guys, XRP is the first crypto they ask him about. That signals it has a ton of mindshare with the people who control a lot of the money, and it could be a major target when that new liquidity flows in. All right, let's tie all of this together. We've got all these conflicting data points, all this chaos. How do we find the real signal in all of this noise? Well, the analysis suggests there are 3 really powerful long-term drivers at play here. First, this whole idea that institutions are quietly buying up assets during all the volatility. Second, the belief that eventually the Fed is going to have to turn the money printers back on with more quantitative easing. And third, this growing trend of companies looking at crypto as a defensive asset to hold on their balance sheets. And that brings us to the core thesis of this whole thing, that the short-term fear, the volatility, this whole nightmare scenario, it might all just be a calculated smokescreen, a move designed to hide a massive, long-term institutional play as they get positioned for 2026. Which, of course, leaves us with the million-dollar question for every investor out there. Is all this volatility a trap designed to shake you out? Or is it actually a historic opportunity in disguise?